If you were only allowed to buy one dividend stock in 2026, just one, which one would you choose? Do you go for the highest yield because it pays you more right now? Do you choose the safest blue chip because it feels stable? Or do you spread it across something that just sounds reliable? Most people choose one of those without realizing they're solving the wrong problem entirely. In this video, I'm going to break down how to think about that one decision the right way. We'll look at what actually drives dividend income over decades, why several popular dividend stocks don't hold up when you stretch the timeline, and how to narrow it down to the one stock that makes sense if you could only buy one. And in the end, I'll show you how that single stock could turn a simple $10 a day investment into a portfolio worth about $2.39 million, paying over $5,000 a month in dividend income. But to get there, we need to talk about the mistake that derails most dividend investors before they even realize it's happening. It usually starts with something that feels completely reasonable. When you're trying to build income, your attention goes straight to dividend yield. A higher yield feels safer. It feels tangible. You put your money in, and cash shows up. That feels like progress. The problem is that yield only describes what's happening right now. It says nothing about why that dividend exists or how durable it is. A stock can show a big yield simply because the share price fell, not because the business got stronger. That's how a lot of dividend traps are created. The number looks generous, but underneath it, the business is slowing, margins are thinning, or cash flow is getting tight. This is where long-term income breaks. Investors start treating income today as if it's the same thing as income 10 or 20 years from now. It isn't. A company can pay a large dividend this year and still be a weak income investment if it can't grow. Without growth, dividends flatten out. And once that happens, inflation does the damage slowly and consistently. Long-term dividend income comes from the business itself, not the payout percentage. It comes from a company that produces more cash over time, not just one that distributes a lot of it today. The questions that matter are simple. Does the business generate more cash as years pass? Can it raise prices, improve efficiency, or sell more without leaning on debt? And does management increase the dividend in a way that keeps the company healthy? When you look at dividends through that lens, yield stops leading the decision. It becomes something you observe after the fact, and that changes which stocks can actually support income over decades, not just the next few years. And once yield is no longer doing the decision-making, a very different group of dividend stocks starts to stand out, and you need to check out 4 core things in these stocks. The first is demand durability. You want a business that people keep paying for in good economies and bad ones. If demand disappears during downturns, the dividend is always at risk. Durable demand means the business doesn't need perfect conditions to keep operating. The second is cash flow reliability. Dividends don't come from plans or forecasts, they come from money left over after the business pays its bills and reinvests what it needs to stay competitive. The best dividend businesses generate more cash than they need, even in tougher years. That extra cash is what keeps payouts going when things get tight. Third is dividend growth capacity. A dividend that never grows loses its usefulness over time. To matter over decades, dividends need room to increase faster than inflation. That only happens when earnings are growing and the payout ratio isn't already stretched. If most profits are already being paid out, future growth is limited. The fourth is capital discipline. What management does with extra cash matters just as much as how much they earn. Sustainable dividend growth depends on responsible payout increases, smart reinvestment, and buybacks that don't weaken the balance sheet. You don't need to memorize these 4 points. Just use them as a filter. When you apply it, some dividend stocks hold up under long timelines, while others fall apart once you look beyond the next few years. That difference becomes clear when you look at a few well-known dividend names that people often feel comfortable owning. These companies we're about to talk about are not bad businesses. In fact, many of them are solid, well-known dividend stocks that can work inside diversified portfolios. The issue is that they break down once you apply the one stock for decades test using the 4 filters we just covered. Take T. Rowe Price as an example. It's a well-run company with a long history of paying and raising its dividend. The yield is higher than average, and the balance sheet is solid. On the surface, it checks boxes that income investors tend to like. The pressure comes from how the business actually makes money. T. Rowe Price earns most of its revenue from managing other people's money. When markets are rising and investors are adding capital, assets under management grow and fee income rises. When markets fall or investors pull money out, revenue and earnings fall with it. That cycle isn't occasional, it's built into the business model. That matters for long-term income because cash flow is tied to market behavior, not everyday demand. When markets struggle, earnings can fall even if the company is well run, which makes dividend growth harder to depend on. That kind of business can fit inside a diversified portfolio, but if one stock is expected to carry income growth for decades, relying on market-driven earnings adds uncertainty. Stepan Company runs into a different issue. The dividend yield is around 3.1%, and over the past 10 years, the dividend has grown at roughly 7.8% per year. On paper, that looks reasonable and checks the income box. The problem shows up over longer stretches of time. Annual share price growth has been just over 1%. When the stock itself barely grows, compounding struggles to pick up speed. Even if the dividend keeps rising, the business isn't expanding fast enough to turn small, steady investments into meaningful long-term results. Target often shows up in income portfolios just because the yield is higher, around 4.3%. Dividend growth over the past 10 years has averaged about 7.7%, which looks solid at first glance. The strain comes from the business itself. Share price growth has been around 4% a year, and earnings can swing widely. Retail margins are thin, and consumer spending patterns change quickly. That unevenness makes dividend growth harder to count on when you stretch the timeline across multiple economic cycles. PepsiCo sits at the other end of the spectrum. The dividend yield is around 4.1%, and dividend growth over the last decade has averaged about 7.4%. The business is stable, and share price growth has been roughly 3.7% a year. Dividend cuts aren't the issue. The limitation is growth. PepsiCo is already a very large company operating in mature categories, so earnings and price growth tend to move slowly. That kind of pace doesn't break anything, but it doesn't compound aggressively either. When this is the only stock doing the work, modest growth becomes a constraint. Over long periods, that slower expansion limits how far small, consistent investments can realistically go. American States Water stands out for consistency. The dividend yield is around 2.8%. Dividend growth has averaged a little over 8% a year, and share price growth has been about 6% annually. On its own, that looks respectable. The constraint comes from the structure of the business. As a regulated utility, growth is controlled by policy, approved rates, and geography. Expansion doesn't accelerate just because demand rises. When growth is capped this way, dividends can increase, but only within narrow limits. That works well as a stabilizer in a portfolio. As the single stock responsible for long-term income growth, that ceiling becomes hard to ignore. When you look at businesses this way, the pattern isn't about good versus bad, it's about limits. Each of these runs into one eventually, and once those limits are visible, it becomes easier to see what kind of business can actually support long-term dividend income without running out of room. Next, I'll show you the single stock that passes all four filters and why. And in the end, I'll show you how that one stock could turn a simple $10 a day habit into a portfolio worth about $2.39 million, paying over $5,000 a month in dividend income. After filtering out the stocks that don't hold up over decades, the focus shifts to the type of business that does. Before even naming it, what matters is understanding what you're actually buying. This business is built around something unavoidable: homes getting older. Every house requires maintenance. Pipes leak, roofs wear down, appliances fail, and minor issues turn into major expenses if they're ignored. That creates demand that doesn't depend on trends or strong economic conditions. Renovations can be delayed, but repairs can't. The company serves two groups that reinforce each other. Homeowners come in for maintenance and improvement projects. Professional contractors rely on it for the tools, materials, and supplies they need to keep their own businesses operating. That mix stabilizes demand. When one side slows down, the other often continues spending. Scale strengthens this further. This is a business with a market value of roughly $150 billion and annual net sales of around $84.26 billion. That size translates into practical advantages: stronger purchasing power, efficient inventory management, and the ability to operate reliably even when supply chains are strained. That business is Lowe's. Lowe's doesn't win by being new or flashy. It wins by where it sits, right between people protecting their largest asset and the professionals paid to do the work. That position creates demand that repeats, stays necessary, and isn't easy to replace. Measured against the first filter, demand durability, Lowe's clears it easily. The business isn't dependent on consumer moods or discretionary spending cycles. It's tied to maintenance needs that persist year after year. The next thing that matters is how well that demand turns into cash. Demand only matters if it turns into cash. Dividends aren't paid because a lot of people walk through the doors. They're paid because after the business runs itself, there's money left over. This is where Lowe's separates itself. A durable business doesn't just sell products. It consistently produces excess cash after covering operating costs, reinvesting in the business, and keeping day-to-day operations running. Lowe's does this through scale and efficiency. Its gross margin sits around 34.2%, showing pricing power and purchasing leverage. Operating margins are just under 11.9%, with adjusted operating margins closer to 12.4%. These numbers aren't extreme, but they're consistent. And consistency is exactly what dividend investors rely on. It means profitability doesn't disappear when conditions tighten. Earnings reinforce that stability. In its most recent quarter, Lowe's generated diluted earnings per share of $2.88, with adjusted earnings of around $3.06. That difference matters. It shows the business can absorb short-term noise while maintaining strong underlying profitability. Earning strength like that is what allows dividends to grow without stress. What matters most is how those earnings turn into cash that actually reaches shareholders. In the recent Q3 quarter alone, Lowe's paid out roughly $673 million in dividends. That payout wasn't supported by borrowing or balance sheet strain. It came directly from the operating cash flow generated by selling everyday products people rely on to maintain their homes. This is the difference between a dividend that looks safe and one that truly is. When dividends are funded by routine operations, they don't rely on perfect markets or aggressive growth assumptions. They rely on repeat demand, doing the same thing year after year. Cash flow reliability also gives management flexibility. During slower periods, the dividend isn't immediately at risk. When the economy cools, Lowe's doesn't have to choose between protecting the business and rewarding shareholders. The cash engine keeps running. Apply the second filter, cash flow reliability, and Lowe's clears it cleanly. The business doesn't need ideal conditions to support its dividend. It only needs homes to exist and maintenance to continue. And that makes the income far more resilient than it appears at first glance. This is also the part where many people hesitate because on paper, Lowe's doesn't look like a typical dividend stock. The forward dividend yield is around 1.8%, which feels small next to the higher yield names we talked about earlier. And if income today were the goal, that would be a problem. But long-term income isn't built on today's yield, it's built on growth. Lowe's pays about $4.80 per share each year, and the payout ratio sits around 38%. That tells you the dividend isn't being pushed to the limit. Less than half of earnings are being paid out, which leaves plenty of room for increases without stressing the business. That room has been used consistently. Lowe's has raised its dividend for 62 straight years, through recessions, inflation, housing downturns, and changing rate environments. Over the past 5 years, dividend growth has averaged close to 16% a year. Over the past 10 years, it's been even higher, around 16.5%. But dividend growth is only one side of the equation. The other side is what the business itself has delivered. Over the same period, Lowe's share price has appreciated by roughly 14.5% per year. That combination, high dividend growth and strong share price appreciation, is exactly what the other stocks failed to deliver at the same time. Some had higher yields but weak price growth. Others had stability but slow dividend growth. None consistently combined both. This is why Lowe's stands out. Even with a lower starting yield, the dividend grows quickly and the underlying business compounds alongside it. Early on, the income looks small and progress feels slow, but over time, those increases stack and the growing share price amplifies the result. That's the advantage of dividend growth. Yield shows you what you get today. Dividend growth and share price appreciation determine what that income becomes over decades. When you apply the third filter, dividend growth capacity, Lowe's easily separates itself from the rest. Dividend growth only works if management handles cash responsibly, and this is where many otherwise strong businesses fall apart. A company can generate solid earnings and still weaken long-term income if it allocates capital poorly. Lowe's avoids that by staying disciplined about how cash is used, and the clearest proof shows up in its share count. Over the past 10 years, Lowe's has reduced its shares outstanding by roughly 38.8%, dropping to about 561 million outstanding shares today. That's not a short-term tactic. That's a decade-long pattern. Fewer shares means each remaining share represents a larger ownership stake in the business. Earnings don't just grow overall, they grow per share. Likewise, dividends don't just rise, they rise per share. This is why the share count matters more than headline one-off buyback numbers. Even in years where repurchases slow down, the long-term trend remains intact. Management isn't buying shares to chase optics or satisfy quarterly expectations. It's reducing the share base when it makes sense and pulling back when it doesn't. That restraint is exactly what disciplined capital allocation looks like. Dividends remain the priority. The payout ratio stays conservative, giving Lowe's room to protect and grow the dividend even when conditions soften. Combined with a shrinking share count, that means dividend increases don't require aggressive earnings growth to continue working. Investor behavior lines up with that approach. There hasn't been heavy selling pressure from large holders, and ownership has stayed fairly stable. Institutions appear comfortable holding their positions rather than rotating out, which usually points to steady expectations around how the business is being run. Analyst expectations tell a similar story. Lowe's holds a moderate buy consensus from 28 analysts, with 18 buys, 9 holds, and only 1 sell. Price targets cluster in a realistic range, with an average around $277, a high near $316, and a low around $242. There's no hype here, just steady expectations. This matters because Lowe's doesn't rely on optimism to deliver results. Its strategy isn't built on aggressive expansion or perfect timing. It's built on consistency. By steadily reducing the share count and protecting dividend growth, Lowe's compounds shareholder value over time. If you apply the fourth filter, capital discipline, Lowe's passes cleanly. Management focuses on long-term per-share growth, not short-term headlines. So what would this actually look like if you invested $10 a day into this business over the long run? We already know the starting point. Lowe's has a forward dividend yield of around 1.8%. That dividend has grown by roughly 16.5% annually over the past 10 years. Over the same period, the share price has compounded at around 14.5% per year. That combination is what the long-term projections are built on. Now, let's say you invest $10 a day into Lowe's with every dividend reinvested. In the first year, about $3,650 would be invested. This sets the stage for future growth. By year 10, projections place the portfolio around $80,000 in value, with annual dividend income estimated near $1,000. By year 20, the portfolio is projected to reach roughly $463,000, producing close to $10,000 per year in dividends. At that point, income growth would be driven more by the business than by new contributions. Looking out to year 30, projections estimate a portfolio value of about $2.39 million. Annual dividend income is projected to be around $65,000, which works out to a little over $5,400 per month. Want to know how to make $6,000 a month in dividends with just $25 a week? Click the video on screen to find out.